A flattening mobility curve amidst a rising pandemic curve is a key risk. This is as per a Nomura report yesterday. And that is the talking point today. And it's good to talk about a doubt with somebody who's largely bullish on the markets, at least to my mind. Let's get in Prateek Agrawal. He's the business head and CIO of ASK Investment Managers and is arguably one of the largest portfolio managers in the country. His view is the talking point today. Prateek, good having you. Thanks so much for joining in.
Thank
Hope all is safe.
All is good. I hope same is true on your side.
Yeah, touch wood. So far, so good, Prateek. Coming on this one, Prateek. So far, the conversation was about the economy opening up, led by economies around the world opening up and the reactions that we've seen thereof. Valuations have gone up a little bit from what they were, obviously, when we were at 7,500. But is this a clear and present danger, a flattening mobility curve amidst a rising pandemic curve in the country?
So there is a near term to it. There is a long term to it. In the near term, yes, we have had a good, nice rally over 35% from the bottom. And if you look at 1 year forward valuation numbers, we are kind of there. We are again on the expensive side on earnings based valuation parameters. However, this thing will pass by. And if you look at then 22, 23 kind of a period, almost certainly in that year, the EPS would be higher than what you saw in 20, maybe even higher than what 20 would have delivered if the pandemic was not there. Okay, that said, shouldn't market discount that a year before? And when I say that, it kind of gives you 16, 17% upside from where we are over the next year and a quarter. And this is without factoring in the rate cuts that have happened and the ample liquidity that is there in the system.
Interesting. So can I ask you what's the basis of you saying that the earnings would actually be higher than what it would have been if COVID wouldn't have happened?
No. I'm saying that in year 22, 23, the earnings that we will get as an economy have a great chance of being higher than FY20 earnings even without a pandemic.
Okay.
So if we believe market should discount that a year before, then over the next 1 year, maybe 1 year and a quarter, there's a great chance that we re-attain the previous highs, which still leaves 15, 16% on the table from here on.
Okay. Embedded in this assumptions are the strengths from the stronger sectors and the weaknesses from the weaker hands as well, Prateek. Because the reason why I asked this is, for example, the common consensus at least 6 months ago was that financials, because of the resolutions, etc., and all, will see a big bump up in EPS even if the other sectors don't. But now that might be under a bit of question mark simply because we do not know what are the kind of minefields that the financial names will be walking on for the next 6 to 9 odd months, right?
Yeah, so I think the commentary that we have seen, after the quarter gotten over from various houses do point to the fact that the amounts under moratorium have reduced significantly. That does give a lot of hope. While everybody is defining amounts under moratorium in a different manner, yet versus what was the experience just in the month of April, it is significantly superior, and to my mind, better than what people would have thought at that point in time. The fear factor then was very high. Second, we do believe that the NPAs would be contained. The bump up on the debt side, even personal debt or industrial debt, to the extent of interest accrued, is not going to be very large, 6 to 10%. And maybe they need some more money to restart business, but that should be possible. So unless the industry is any which way on the verge of caving in, the slight increase in debt as a consequence of lockdowns for 2 months should be sustainable, is what our sense is. And that gives financials, which to our mind still continues to be the cheap part of the whole market. This is one part which is still over 25% down versus the peaks that we saw,
Yeah.
uh, could could present a upside.
Okay, and I'll talk about that in a bit, Pratik. We'll get to sectors in a bit as well. I would love to, but just before that, a couple of questions. You would have far greater access to business confidence and managements than most people do. What's your sense when you talk to them? Are they, because everybody seems to say one thing, that it is uncertain what will happen. But in close quarters, in private conversations, are companies also telling you that the uncertainty is only for the next 3 to 6 months and they are confident about the slightly longer term?
So everybody would like to take a day at a time. These are uncertain times, so practically nobody is saying that after 2 months, 3 months, everything is going to be good. Because
Okay.
what is happening is people have lost jobs. What is also happening is people have seen wage cuts in the marketplace. The discretionary expenditure is definitely down. People want to save for the rainy day and so on. So there is that fear factor. Now it may normalize. The start has been good. There has been some amount of tailwind from deferred demand of 2 months of lockdown. So all of that is good signs, but nobody is willing to commit just now that quarter two, quarter three would be good, especially when the numbers that we are seeing in the country are still increasing.
That's true. I just wonder, Pratik, do you think that the earnings picture could still look okay even if two things happen, that the numbers increase and the economy doesn't recover? Because a lot of people make this case that a large portion of the Nifty earnings is not even related to what the economy would do, or maybe due to the lockdown, the things stay lower. Is that a correct hypothesis?
I would not believe so because, for example, banks, coming back to financials, the short period stress can be taken in this stride. That is possible. But if economy stays lower for longer, then obviously NPAs, delinquencies, etc., will move up, and the kind of provisioning that banks may have to do for a long period of time may be very high. So it all depends on the period. It's good that we are opening up. We have decided to open up, even though the COVID numbers continue to increase, because otherwise the economic cost would have been just too high. The parts of the market which are commodity related would see a softness, weakness if the economy doesn't come back up, and there the earnings would again get impacted. Spaces which are slightly, let me say, COVID proof may prove to be IT, where people have evolved to working from home in a big way. There the damages may be lower. It could be agri related, where the government has been able to shield that part of the economy very well. Rains have been helpful, and we will get a higher crop over last year, which was again higher than the year before, with good prices. So that part of the economy should continue to tick well. But that said, large part of the economies are is city centric. Will get impacted if COVID numbers continue to rise, and the fear factor sets in, and people curtail spends.
So that remains the clear and present monitorable. Okay.
Yeah.
But before we jump in full into sectors, Pratik, one question on the index valuations as well, because there's a lot of argument about whether you look at the P multiples because they look elevated versus you look at price to book multiples because they don't look so elevated. Now, which one would you look at and why would you do that when you're making your investment decision?
No, once again, there is a long term and a short term to it. If you look at the longer term, the asset based valuations, market cap to GDP is, just about the GFC levels. If you look at price to book, again, lower than the averages that we have seen over a long period of time. So that gives you a sense of the upside that is there in the market as situation comes back to normal. And it is good to keep a sight on that. But at the same time, for the near term, if the earnings don't pick up, the longer term just gets more and more longer. So earnings need to also come back, and that is why people keep looking at how each quarter will happen, how financial 21 would do over 20 and 22 over 21. So the longer this thing goes, I think the comeback of the market can get elongated. But that said, today the thought is the numbers or the fear, because people are dying in large numbers because of this, get addressed. Let's say once a medicine comes in, once a vaccine comes in, that seems to be order of the day. Sometimes middle of next year, if not earlier, and that would then clearly mean that 22 would be more normal and 23 would be definitely higher than what a 20 would have been without a COVID. So I say that because 20, the last quarter got badly hit. Otherwise, in 20, we were on a very decent uptake in the third quarter and till Feb end in the fourth quarter.
Yeah, that's a pertinent point too. I think one of the most commonly circulated images these days is of people pulling off their mask and throwing that in the way they throw the graduation cap, thinking that okay, COVID is now behind us. I think everybody's waiting for that moment. Yeah, Pratik. So let's delve into a few things. Now, you spoke about financials briefly. If I can just ask you a little bit there, there is the common thing that I've gleaned in all the talking point conversations thus far seems to be that keep on betting on the large 3, 4 quality names, because that's where, if nothing else, then the market share gains will happen, and if there are speed bumps, then they will navigate over them in a better fashion. But the valuations are obviously more rich, as they always have been compared to the others. So, how do you justify the pros and cons of this approach, if you indeed believe in the same thing?
No, we actually propagate the same thing. We are focused on quality. This is a period where what we define as quality. Great businesses turning out good ROEs on the side of banks, good ROCs for other businesses, free cash flow generating companies have a great chance of improving their market presence. So imagine a marketplace where one player is levered in a pandemic where the future is uncertain. How does that behave? He would want to pull back working capital as much as possible from the channel, versus somebody else who has cash on book and would then be able to handhold the channel much better. And you would then believe that after the pandemic is over, the cash on book guy would have strengthened their position in the marketplace. So that is clearly something to be expected. It is happening in varying degrees all across. So the stronger companies gaining market presence over not so strong. In fact, organized sector gaining presence over unorganized also is happening, because organized guys have been able to bring back production quickly. So overall, while demand may be lower, we are seeing them actually maintain, if not improve, working capital cycles. And that is something that we have latched on. It doesn't usually happen in bad times, but that is what is being witnessed. And we really believe that as things normalize, the move from unorganized or less capable to capable would have accelerated.
Okay. Would that argument extend to the other facets of financials? Because the lending financials are discussed a lot. I know you in the past have explained beautifully why some of the asset management companies, for example, have great long-term moats around themselves in terms of valuations, because there's a natural uptick in the AUM and therefore the fees thereof. What about that entire bucket? Asset management companies, brokerage companies, simply because of the number of people that have started opening accounts, and the likes of CDSL, etc., and all of that. Um, Loosely clubbed in financials, according to me. But what are your thoughts onto that pocket?
Yeah, so the fee-based financials are nicely positioned, while the insurance companies won't deliver a growth, okay? Because while the awareness is high, and people would want to buy insurance if required, going to the doctor, going to the clinic to get a health checkup done, and that prevents a large uptake. Otherwise, the regulatory framework, the mind share, everything, the tailwinds are with insurance, both life and general. So, but 21 over 20 would be a degrowth year to our mind, while 22 over 21 would look much better. In terms of brokerages, well, there has been a fee pressure, and that has caused the discounting of brokerage profit to be much lower than other parts of the marketplace. But yes, this quarter would be good for anybody who is a retail broker. Number of accounts have really ballooned. The market share of retail is touching like 90%. So anybody who is a retail broker is seeing a lot of traction. They may have had one of their best quarters ever last quarter. Coming down to the asset management businesses, well, I'll share with you an interesting data point. Top 10 asset managers account for 95% of the profits of the industry. Most of them, many of them are supported by very, very strong banking distribution franchisee, and extremely difficult to dislodge. So be it an HDFC, while bank is not the parent, but still same brand. SBI, ICICI, Access, they have a lot going for them. Distribution is the key in such businesses, and people who have support of the banking channel really are in a good place. We do believe they will continue to strengthen their relative position in the marketplace. So we have been focused here in this space with some small investment, but yes, we are invested in the fee-based financials, life and general more, but even some bit of AMCs.
Okay, interesting. The other bit is, Prateek, I was looking at your June presentation, and there are some high frequency indicators that you've indicated which point towards some positivity. There is the cement dispatches, power generation, or even the employment data, which has shown a really sharp up and down take. What do you make of this, and what are the investment implications thereof?
No, so they are providing a lot of hope. For when we went into the lockdown, the whole debate was whether we will get a V, whether we will get a U, W, all kind of numbers, letters. But the way the market has come back, the economy, at least some of the sectors have come back, do point to a V-shaped recovery. Yes, it is helped by 2 months of pent-up demand, and hence we will still have to wait and see how it pans out over a longer period of time. But the start has been good.
Okay. There is much talk about cement as a pocket as well. The companies have proven largely resilient, and if indeed these dispatch numbers are anything to go by, there was some talk of price hike as well having happened. It sounds slightly counterintuitive, doesn't it, though, Prateek? Can you talk about that a bit? What are your thoughts here?
Yeah, yeah. Cement is a very interesting commodity. One, it is a commodity with pricing power demonstrated over long
Yeah.
periods of time. Okay. Two, it's a commodity with very high energy intensity. So if crude prices are low, coal prices are low, the cost of production of cement would be lower, and we saw a large gross margin expansion in the fourth quarter, and we do believe we will see it again in the first quarter and subsequently as well. Third, the demand for cement is more, tier two towns and hinterland. Cities account for 18% of total demand. It is very well supported by the government spends and rural economy. So, if you believe infrastructure would again be the focus of the government to kickstart the economy, the damage overall to cement demand as a consequence of economic slowdown would be lower than other spaces. And helped by gross margin expansions, this is one space which can still deliver, to my mind, some EPS growth in 21 over 20.
Okay. Okay. Towards the end of this interaction, viewers, I'll ask Prateek Agrawal about what has intrigued him the most or what has confused him the most when it comes to the last 6 months, last 3 months. But before that, one other pocket that I do want to talk about, and that is agri. Pratik, almost everybody believes there is an antique note today, and not that that note is anything saying something new, but it almost sums up what everybody's saying, that probably the best quarter ever for these companies. Now, and National Fertilizers, a small company, said that they've had the highest dispatches ever in their lifetime in quarter one. Now, it's a very wide bucket, some direct, some indirect plays. What is your sense? How do you approach this one?
Yeah, so agri is something like we said has held up very well. Government has been very successful in shielding that part of the economy. The cases there have been lower, so it's business as usual there. Last year was good, so people have money in the pocket, and this year the amount of buying that the government has done is an order higher than last year, and Narega spends have been increased by 40,000 crores, to support people who are going back from cities to the hinterland and so on. So this is a part of the economy which is doing much better relative to others. Now there are a few direct plays, yes. So fertilizer companies, seed companies, insecticide, pesticide companies should all be expected to deliver good set of numbers. There are some indirect plays, two-wheelers, for example. We do believe lower-end two-wheeler manufacturers, 100cc, 125cc bike makers, should see their numbers come back better than other parts of the economy. Tractor manufacturers, farm equipment should all do well. Now, even for the other parts, for example, consumption, electrical, small electricals, geysers, heaters, coolers should all do very well. And even in FMCG, people are saying this part of the market is holding up much better versus the cities. So, but then, the more direct a play is, the better it would hold out versus the others. And after 2 good years, chances are that the third year, at least in the beginning, would also be good. But that said, while this is a part of the economy which will do very well this year, okay, this year market would be happy with a small growth. Next year again, agri doesn't increase in strong growth numbers. A 5% growth number in agri is a very good number. Okay, so when the situation normalizes, the other parts of the economy will be able to deliver way more stronger growth versus this. So while being exposed to this part is good for the time being, one should be able to transition to the other parts once one sees economies to be the situation on COVID to improve.
Okay, so be nimble-footed. Just a quick follow-up there, Prateek. One, uh, is there some valuation comfort in any of these themes? One, because the stocks have gone up a bit. That is part one. And part two, uh, maybe one size doesn't fit all, but what's the percentage allocation, for example, that you have to this agrarian theme, with the caveat that you pointed out that people need to be nimble-footed. So what does a large manager like you do? Does he allocate a large proportion because there is earnings growth, or a small proportion?
Yeah, so agri, direct and indirect put together would be 5 to 10% of our portfolios.
Okay.
So it is large. If you look at the index doesn't have any. So that way, in terms of delta index, if somebody is looking at relative, it is large. But in this space, you don't get large liquid names. So that again is a constraint. Most of the direct plays, the seed plays, the insecticide, pesticide plays are larger mid cap companies at best.
Yeah, that's true. And what about the valuation comfort or lack of it thereof? Because these stocks have all gone up now already. But is there still valuation comfort
So
or investment comfort?
yeah, valuation comfort in a large part of the economy on traditional PE-based valuation is not there, unless one factors in lower interest rates and hence lower discount rates. We do believe it is too early to do that, given the fact that the situation on the ground is still evolving, and one should expect in such times that the risk premiums that should be applied should be higher. But in a lot of these spaces where things are impacted less, we are seeing valuations really hold up. So from known sources, valuation comfort is not there, but in many cases there are some option values. So, for example, if there is this Make in India thrust from the government, one big space where this can be affected very easily is chemicals, APIs, pharmaceuticals, where India has the ecosystem. In fact, apart from China, India is the only other country in Asia which has the ecosystem. So even if somebody wants to go to a Vietnam or a Malaysia, it would be very difficult. We do believe we would gain substantially here. Now, there is some policy tweaks that we believe are happening to support Make in India initiative, substitute imports, etc. Now, that can give a leg up to the growth in this space versus what people may have expected earlier. So, a lot of the APIs, a lot of the intermediates that people may have imported from abroad may get substituted. And if the government lends a helping hand, it may even be decent on ROCs.
Got it. Okay. Pratik, one last question. What has intrigued you? What has confused you? What has befuddled you? I mean, surely you also don't have all the answers. So, what is it that when you saw, you thought that, hey, this somehow doesn't make sense, or I can't put a piece to the puzzle?
No, so if you look at our monthly videos one after the other, the last or maybe the last to last, we were tagged down for sure. We thought the markets will stay lower for longer. It's come back up significantly sharper than what we would have thought, at least I would have thought. In spaces, for example, automobiles, where numbers are not happening, where production worries are there, and the manufacturers themselves are talking of the same. Not only the same manufacturers, but also their financiers have seen a large uptick in the market. So that's again something that has foxed me, and but that is how it is. The strength of the rally that we have seen over last 1 month has been very, very strong.
Okay. Well, maybe that is one thing that everybody should wonder as well, because some people are okay with it. Some people have questioned the strength and the pace of the rally. But Pratik, it was so good chatting with you today. Thank you so much for explaining some of those nuances as well. Really appreciate your time.
Thank you. Have a good day.
Thank you. You too, Pratik. Thank you. And viewers, thanks for tuning in to this edition of The Talking.